For 5 years, every raise bonus and tax refund went straight toward a 4% student loan, and that decision still left me financially behind. Should you invest or pay off debt first? I treated debt repayment as the automatic answer and measured success by how quickly the balance fell. But while I chased a zero balance, I ignored the employer match tax benefits and market returns available during those same 5 years. Here is how that decision actually cost me. I was making $140,000 a year and carrying a single fixed-rate student loan at 4%. I had enough cash flow to repay the loan and invest at the same time. Instead, I created a strict rule. Every available dollar went toward the loan before I invested anything. I opened a taxable brokerage account and selected a broad market index fund. After reviewing the holdings, expense ratio, dividend history, and long-term return, I calculated a fixed monthly contribution. Before submitting it, I opened the loan dashboard. An additional payment reduced principal, lowered future interest, and moved the payoff date forward. The brokerage offered no comparable confirmation because its value could rise or fall after purchase. I cancelled the order, sent the same amount to the loan, treating a visible result as proof that it was the stronger choice. The next contribution date arrived after the index had declined. The lower price should have made the fund more attractive, but the drop made the risk easier to see. I repeated the additional payment and left the brokerage account unfunded. When the market recovered, the decision did not change. The fund now cost more than it had when I first selected it, and buying after the rebound felt less efficient. An annual bonus created a larger test. I transferred the full amount into the brokerage account and entered an order large enough to establish the portfolio I had planned. I left the order pending overnight. The next morning, I compared that purchase with the student loan payoff schedule. Applying the bonus to principal would remove more than a year of payments and bring the balance within range of an early payoff. I cancelled the order again. Nothing prevented me from starting. The faster payoff simply looked more valuable each time I delayed. By the end of the first year, the loan was far ahead of schedule, but the brokerage account still showed zero. The faster payoff made that absence feel temporary rather than costly. That temporary delay became the final decision of the first year, and the next statement would determine whether the same rule continued into the second without revision again. The next annual bonus removed another section of the student loan without eliminating it. What had begun as a preference for certainty was becoming a system with a visible end. I reviewed the retirement plan during the same month. The plan offered broad market funds and matched a percentage of every paycheck I contributed, with immediate vesting and no year-end true-up for missed matches. I calculated the annual company contribution, then compared it with the interest another year of accelerated payments would avoid. Receiving the match required redirecting part of each paycheck from the loan. The retirement account would begin accumulating assets, but the payoff schedule I had spent 2 years advancing would slow immediately. I left the contribution rate at zero and preserved the monthly payment, moving the date closer. Another bonus brought the projected payoff within 18 months. Reaching that range changed every alternative use of cash because a retirement contribution now seemed capable of delaying a finish already close. I transferred the full bonus to the loan and watched the remaining term contract again on the updated schedule. The strategy had become self-reinforcing. Earlier payments made the balance smaller. The smaller balance made completion feel nearer, and the nearer completion became, the harder it was to direct money elsewhere. By the end of the third year, the student loan was several years ahead of its original schedule. The brokerage account still had no completed purchases, and the retirement account still showed 0 employee contributions and 0 employer deposits. The next projection showed the loan ending before the date I had once expected to begin investing seriously. Another year of delay appeared minor because the repayment strategy seemed almost complete. I carried the same allocation into the next payroll cycle without comparing the compensation already forfeited with the interest I had saved. Nothing in the statements I reviewed suggested the method was incomplete. The first evidence against the strategy would come from an account whose missing balance had never appeared as a loss. The first crack appeared when I returned to the retirement plan and calculated the match I had forfeited. Using the plan's matching formula and 5 years of payroll records, I worked out what the company would have contributed if I had participated from the beginning. The total exceeded the student loan interest my extra payments had avoided. The debt strategy had not failed. The student loan remained years ahead of schedule, and every additional payment still reduced future interest with certainty each month. The contradiction came from compensation that had disappeared without ever appearing as a charge, loss, or negative balance. The retirement records confirmed 0 employee deferrals and 0 company deposits across all 5 years, because the plan matched contributions by paycheck, offered no year-end true-up, and vested every match immediately. None of the missed contributions could be recovered later. Each paycheck that passed had permanently closed the matching opportunity attached to that pay period. I compared 1 year of forfeited match with the additional student loan interest required to make the contribution. The match was larger. That comparison reached only the retirement account. The brokerage account still showed no purchases, no distributions, and no reinvested dividends. I had opened it before making the first extra loan payment, selected a broad market fund, and then left the account empty through every market cycle that followed. The fund history showed declines during those years. Each decline had justified waiting because debt offered certainty. The same chart also showed recoveries that lifted the fund above every price I had rejected. Avoiding the declines had also meant missing the recoveries. I checked the price from the month I first prepared an order. The contribution I had redirected to debt would have purchased more shares then than the same amount could purchase now. That result reflected the market period that followed. I did not need to assume an unusually strong market return to see the first gap. The employer match alone exceeded the additional loan interest, while the missing brokerage deposits remained a separate market-dependent question. Accelerated repayment still had measurable value, but it was no longer the complete measure of the decision. Another annual bonus arrived while I was reviewing both accounts. Under the original rule, the entire amount would reduce principal. For the first time, the student loan balance no longer provided enough information to decide where the money belonged. I left the bonus in cash and compared the two paths again. Sending it to the student loan would preserve the earlier payoff date. Investing part of it would build assets while leaving more debt outstanding. So the result depended on returns, taxes, liquidity, and additional interest. The strategy had reached a point it was never designed to handle. It could prove that repayment produced a guaranteed interest saving, but it could not prove that applying every dollar there maximized net worth after employer matching and taxes. The next calculation would measure whether combining normal repayment with investing had produced a stronger net worth result during this specific 5-year period. The annual bonus was sitting in cash when I opened the student loan account and entered it into the amortization worksheet. The projected payoff moved forward by another 7 months. For 5 years, that result had always immediately ended the decision. This time, I opened the retirement portal before submitting the payment, then placed both accounts beside the brokerage history that still showed no completed purchases. The difference was no longer theoretical. The loan account showed the remaining principal, while the amortization model estimated interest avoided and payments removed. The retirement records showed 5 years without employee deferrals or employer match. The brokerage account showed a completely empty transaction history throughout. I started with the employer match because that benefit did not depend on market performance. Increasing contributions now could not recover compensation tied to paychecks that had already passed before then. The employee contributions required a different calculation. Traditional deferrals would have reduced taxable income, while extra loan payments came from after-tax cash. I compared equal reductions in take-home pay and credited the debt path for every dollar of principal it had already removed. I then opened the broad market fund I had selected before making the first extra payment. The price history included declines that had convinced me to wait, followed by recoveries that had convinced me I was already late. Buying on the original schedule would have spread contributions across both instead of requiring one perfect entry point. The employer match changed the comparison from the first eligible paycheck because its value exceeded the additional interest required to retain that cash. That was the first result the loan dashboard could not display. It showed every dollar of principal removed and interest charged, but not the employer contributions forfeited or the shares that scheduled brokerage deposits would have purchased during those same 5 years. After 5 years, I compared equal cash flow costs across both paths. One held less debt, the other held investments and more debt. I added the employer match and converted the retirement assets to after-tax value, but the brokerage result still had to be calculated. I then applied the fund's total return across the original contribution dates rather than one average return. Earlier deposits remained invested longer, later deposits entered at different prices, and total return already included every reinvested dividend and distribution. The completed comparison put the combined strategy ahead over those 5 years. The employer match created the first advantage, and the fund's return widened it. At 4%, Sending every available dollar to the student loan cost more than keeping the regular payment and investing part of the difference. I raised the loan rate in the same calculation. The advantage narrowed and eventually shifted to accelerated repayment. At a high enough rate, investing while carrying the debt would have reduced my net worth and cost more than paying the loan first. I should have checked which strategy would cost me more before committing to either one. The answer depended on my loan rate, employer match, taxes, and investment return. I chose debt automatically, without first checking whether that rule fit my situation.